Welcome back to another episode. Thanks Mike for joining again.
No worries, Josh.
And I'm Joshy K. We had quite a meaty topic last time we caught up around, supercharging your 40's and 50's. So we thought we'll spend a bit more time on that today. And maybe it's worth starting with a bit of a recap on what we talked about last time.
Yeah, sure.
Yeah.
Hope you've got a better memory than me.
Yeah, well, on a high level, I guess we talked about it's the meaty time of life where you're starting to earn more money.
Yeah.
You're getting a handle on your home debt,
Yep.
so primary residence. Oftentimes the consideration is, do I put more into superannuation versus paying down mortgages?
Yeah.
And,
Popular question in this era.
yeah, and I guess the answer that we had for those who haven't watched it is, it depends. It depends on your marginal tax rate, depends on what interest rates are doing, also depends on what your goals and objectives are over the next 10, 15 years.
Yeah.
Also depends if we talked about 40's and 50's, but that can be anywhere from age 40 to 59. So it depends on where you're at in that demographic as well. So check out that video, certainly worth a listen. Any feedback or anything you want to learn more, reach out and we're happy to do a topic on it.
Yeah, I suppose maybe we spend a little bit more time on that debt consolidation, for want of a better word, into that era. Probably paid off the student loan. HECS debts might have been paid off by this era, so you might have a bit more free cash flow. There might be a few, unwise decisions from previous eras that was hanging around, like other loans or high interest debts and stuff like that. So, do you want to unpack a bit more what sort of this could look like for the debt side of it?
I suppose if we start at that younger end of that side, so let's just say someone's 40, they're probably starting to earn an income where the HELP or HECS debt that they've accrued previously, if they haven't already paid it back, it actually starts to play a role in their day-to-day cash flow and what's coming from their pay slip, because as you earn more, you've got to pay back.
Yeah.
On the other end of that, if you've already paid back that debt, you actually find your liabilities are starting to drop. So things like your borrowing capacity might be starting to increase. Some people don't realise your HELP debt or HECS debt does form part of what you're eligible to borrow for.
Yep.
So if you're looking to upgrade your house, move locations, it's something that needs to be considered. Do I clear the HELP debt or not?
Yep.
You mentioned kind of tidying up previous debts, so that can be anything from a simple credit card or a payday loan to a boat loan, motorbikes, there's personal loans, all of those types of things, trying to get them all consolidated, because as you're accruing wealth, oftentimes it's all about earn, grow, things are busy, you've got kids, and next thing you know, you've got stuff in all these locations.
Yeah.
So as you get your 40's and 50's, I guess taking a step back and going, where is everything at? What does reality look like? And then how do I gain control of this? Yeah.
Especially if you are a homeowner, so there's equity that's been built into your home, primary residence.
Is it worth touching base on what equity is? I think that's the term that's talked about, but probably the different levers on what equity.
So equity to me is just what the house is worth in market value terms. So $700,000 house, that's what it's worth, not what you paid for, and compare that to how much you owe the bank basically. So you might have a $300,000 debt, so the $400,000 is your equity in that example, and that equity is gained. So typically when you buy, I was going to say about a 20% deposit. Now first owners, we have a 5% deposit option, but rule of thumb traditionally has been about 20% deposit, which is sort of like your starting equity position, and then that equity position grows because you're paying back principal and interest off your home loan, as well as property traditionally increases in value over time. So you're getting a stretch or increased equity from two sources in that scenario. So what it is that pretty much banks look at two aspects when they're looking to lend money. It's equity, or they call it loan to value ratio, how much you loan compared to the value of the property lending against. And the second aspect they look at is serviceability, which is pretty much what's your free cash flow, how much buffer do you have. So in your 40's and 50's, you've probably got two winners there, because you've probably hoped to build a bit of equity, as I said, for those two sources. And as you mentioned, some of your liabilities like HECS debts dropping off, and a few other things are under control. So your free cash flow, you probably come into peak earning capacity in career progressions and things like that. So you've got really strong serviceability. So why not utilise that equity in your home to knock out, say, like your boat loan and all that sort of other stuff that you might have accumulated over the time, Because normally the interest rate on mortgage is the cheapest form of debt, typically, compared to interest rates on other forms of debt, whether it's unsecured, meaning the lender is not no security, or it might be secured against an asset like a boat or a car or something like that. So typically they tend to be higher interest rates, rule of thumb. So yeah, so you can use a lower mortgage rate or interest rate to bring all your debts, sort of consolidate all your debts under one sort of loan.
Yeah. I guess the key consideration there is looking at if you've got a 5-year motorbike loan as example and it's paying 12% interest, you can figure out what that interest would be over 5 years versus is it actually going to be better off consolidating this into a 6% loan but having that for 20 years?
Yeah, that's
and
right.
seeing those repayments. So
yeah, and the other trick with some of those short-term or equipment-based loans, I've seen the fine print where the early payout is almost worth nothing. Like they've factored in that you still pay the residual interest as if you were still paying it over that period. So it's just another little thing to check out if you're looking at it, get a payout figure from the finance company, so for motorbike loan, and just double check that there is a discount for early payout, not, we give you 1% discount, but you're really just prepaying the next 3 years worth of interest.
Yeah, it's a good point. Always important to check those terms and conditions, and if you're unsure, to reach out to your accountant or your financial advisor to have a bit of a look.
Yeah.
I think equity is an important one. So, I mean, you've kind of mentioned, so it's increasing the value of your home as you're paying down the debt, and that gap or that spread becomes equity.
Yeah.
If you're always going to live in your home, you might say, why do I need equity? It's just kind of sitting there. But for some people, it's debt consolidation. It can be, is it worth actually taking some of that money from redraw and investing it? And now some of that interest becomes tax deductible. So it's called debt recycling. So it starts opening up what options. And again, we're big proponents of financial flexibility. So gaining equity in your home can be a really good tool.
Oh, I think it's great. It's still one of your best assets, both from lifestyle, home development, your family development, and also from a tax and financial planning perspective, it's sort of the rock that you can leverage from. So some people are a bit more aggressive. They might want to use equity in the home to buy a property or some other forms of investments. So that's where you use that gap that you spoke about to leverage to buy another property. Or some people might say, well, I might upgrade my home and then either let my existing family home that becomes the rental property, or sell it and I want to upgrade because I don't want to take that extra risk. And everyone's sort of tolerance of risk and what they see is all different. So, but it gives you that optionality, I suppose, is the main point.
And that's where, as much as we're going to try and keep this as 40s and 50s, I feel like we're almost going into the property side because there's so much you can do with property, not only for lifestyle purposes, because where you live also affects oftentimes your friendship groups, how you show up to work. If you're in an apartment versus you've got a nice garden that you like to work in, like it all affects how you then show up in your career, which then affects your other finances. So I
think it just brings into play some other conversations, whereas in the early days you just probably getting what you can afford in terms of location, type of house, stuff like that, with kids or whatever your family scenario is. Whereas now you're sort of starting to have a little bit of breathing space, a bit of oxygen back in the lungs, and you're going, oh yeah, what'd that look like? And I think we touched upon last time, it's, in this era, it's sort of like a very common question is that superannuation, I can sort of see a bit of a finish line happening. Do I pay down my mortgage versus putting more into super, which is the depends answer that you gave last time, which is a good answer. But maybe we could skip over to super and sort of unpack that a bit more, what at a high level, the options that people have again.
Yeah, I think that's a good one. So yeah, again, when you're in your 20s and 30s, superannuation is just this thing you see on your pay slip. You occasionally get an email from the fund saying something's changed with fees or insurance, and you don't really think about it. Naturally, I would like people to start thinking about it, because the earlier that you get to that, the better you are off. And I guess the analogy we've used previously is around that plane leaving Launceston. If it's heading for Cairns and it's off by 1 degree, by the time you travel that few thousand kilometres, you miss the mainland entirely. So getting on top of these things in your 20s and 30s is important. But it's not too late to look at it in your 40s and 50s. So that's the key.
Certainly not too late at this point, but
No, and the way I also look at it is when you're, I guess, 20 years old, you've got between then and age 60, so you've got 40 years to develop enough wealth to get you through from say 60 to 90. So you've got 40 years to save for the next 30, and usually for most people, the biggest tool to come to play is superannuation.
Yep.
Because of the tax effective nature on it. So definitely important to get on top of that soon.
And to reinforce, it is your money.
It is your money.
So many people say it's not my money, the government are going to tax me, whatever. Okay, but it is effectively your money held in reserve until you reach retirement or your conditional release. So.
Yeah, and that's the key. So we've talked in the last video around superannuation is just a trust. That's all it is. Same as that trust fund kid. They've got funds preserved or locked away until a set age. Same thing in Australia. It's just until you meet a conditional release, i.e. you retire. A couple other ways you can access super, but they're less favourable than retirement. So we won't go into that. But some ways that you can start thinking about your superannuation is, even if we're not talking contributions yet, just finding out where is my superannuation.
Yeah.
So product provider, what investments are available, what features are going to suit my spouse and I and what we're trying to achieve, because they're all different.
Yeah.
You'll have different service offerings. How much am I paying is another one. So your fees are a big one. And mainly it's around the investment side of things. And then once you've optimized that, now for every dollar that I tip into it, knowing that it's going to the right places, what's the most effective way to get money into super?
Yep.
Because once it's in, I can't take it out until I meet that condition of release.
That's right. That's the dilemma. So the flexibility you have, say, from paying down a mortgage versus really great tax outcome and great long-term planning tool to put more money into super, but it is locked away until you basically retire. So that's the big question, and that's why it depends on a whole series of factors.
Well, and it's an aptly named financial strategy. It's called salary sacrifice for a reason, because you are sacrificing your salary not just into your pay packet, but also now it's preserved, it's locked away, and that can be a really good thing from a behavioural perspective, because you might say, look, I'm not going to notice $50 a week. Yep. I'd spend that on maybe not a carton of beer these days with inflation, but that type of thing.
It's all about coffee.
Yeah, well, that's right. But just automating that. I mean, $50 a week doesn't sound like much. That's $2,600 a year with compounding times a few decades. It starts to add up.
Yeah. So just unpack it a little bit more. Just remind people that salary sacrifice versus other forms of contributions.
So salary sacrifice, if you're setting that up, is an arrangement done through your employer, where each pay cycle, before you get taxed on your income, they put a portion of that into superannuation.
Yep.
Now you still do pay tax on it. It's called a concessional contribution. So it goes into super and it's concessionally taxed at 15%.
In the super fund, not in your own name.
Yeah, that's correct.
So at a macro level, there is still tax, but from a outside super, you get effectively whatever your marginal tax rate, say it's 30 cents on the dollar, effectively you get
the difference.
Benefit outside of super.
Yeah, and the reason it's called a concessional contribution is, again, it's a discounted contribution. So other times you would have heard the word concession would be maybe you're buying a movie ticket at a theatre, you're catching a taxi, they go, do you have any concessions? They're asking, are you eligible for any form of discount? So concessional contribution, discount on the amount of tax that you pay.
Yep. Yeah. And there are caps, so people might have thought about the current cap is $30,000 per annum for concessional contributions.
Yep.
So people might have heard of that. I do have a cap. Bear in mind that you've got a discretion for a component of that, but if you're working, your employer's already putting 12% in, which comes under the concessional definition. So you've got difference between what your employer puts in and what the $30,000 cap. The other one which comes up quite often is that carry forward. If you've got less than $500,000 in super, you can go back 5 years, and if you haven't reached your cap, bring that forward, which is a really effective strategy for a lot of people.
So I suppose using round numbers, if you've got that $30,000 cap and say your employer's putting in 10,000, you've got that 20,000, you could top it up.
Yep.
If you go back 5 years, each of those years you also could have topped it up 20,000. You don't necessarily lose the ability to put money into super. You can kind of take advantage of that and go back in time, provided your balance is under $500,000.
Yep.
So for those who are in a position to actually top that up, it's usually because of, I guess, either high income, which plays a different role on whether or not you should be putting extra contributions in with Division 293. There's a few tax laws, but also looking at, you might have sold an investment property, so you get this huge lump sum in, you've got this big capital gain, you think, how do I give less to the ATO but also help my future? Maybe it makes sense to put money into superannuation, take advantage of that.
Yep.
If you know that's coming up, it can make sense to employ other strategies such as spouse contribution splitting to free up your balance and make sure you don't go over the $500,000 to allow for a future event. So this is where tax planning really comes into it. So there's a lot we can unpack, but I feel like that's a pretty good summary, as I guess, of
Yeah,
stage two.
one other point before we sort of wrap it up is just that review, the asset allocation mix, I think is really another important element within the superannuation fund. Just a reminder what that looks like in terms of growth versus defensive versus balance and stuff like that.
Okay,
We
so
spent half an hour on it, but maybe just
and we
a
probably
quick
should
reminder.
at some point, but look, we call it risk profiling. Effectively, you'll hear terms if you look at your super fund statement, you might be in the balanced option or the growth option, which doesn't actually tell you a lot about how you're invested. But what's really important is, again, asset allocation, sort of broad level. How much of your money is designed to grow, so it's at risk, and how much is designed to protect the money you've got, so they're defensive assets. So if I then break down those individual components, think about growth would be maybe international shares, Australian shares, property, a couple of those types of things, and then you've got other assets that are defensive, so more like your cash, your term deposits.
Yeah.
Other alternatives could be investing in toll booths, etc.
Yeah.
There's a couple of different ones, but at a broad level, just understanding how your superannuation is currently invested, because if you're a wealth accumulator, so let's say you're in your 20s or 30s, you're not going to access super for probably the next 30 years. Even though you might be a bit more conservative when you're just in your everyday life, it could make sense to actually take some risk because you've got time in the market. And so it might be appropriate to be in a high growth profile instead of in cash. Versus if you're about to retire in the next 5 years, you might not realise you're in a quite aggressive portfolio. And what we don't want is your portfolio to drop by 15-20% the year before. So important to understand your super fund. Again, we could talk about optimising each of those individual categories of shares and property, but it's probably another.
Yeah, well, I think just people being aware of, at this stage, having a really in-depth understanding of their asset mix within the super fund, because as you say, their time horizon is visible, but also it might be short as well, like in relative terms. You can't ride the market wave if you're planning to retire in 3 years, for example. So.
Yeah. And also worth pointing out that even if you are retiring in 2 or 3 years, that doesn't mean the day you retire, you withdraw the money from super, you put it under your mattress. So it's also, is this money still going to be invested, even though we're drawing down from it for a period of time that could be appropriate to still take some level of risk, even to combat inflation.
All right, thanks Josh. We might wrap it up there. So I suppose just in summary, in the 40s and 50s, we've got a bit of extra capacity to have a few different options available. That could be consolidating debt and reducing some of your high interest debt, looking at a serious superannuation contribution strategy for the next X years as part of that planning, and really having a more in-depth understanding of where your superannuation fund is sitting in terms of the asset mix, as well as that optionality of using the equity in your home for a whole range of different purposes. So hopefully that's assisted in the 40s and 50s. We've done a couple of sessions on this one. So
there's so much to think about, so much to cover. So again, we'll might leave it there for the day, but I think it was a good summary, and we'll see you guys in the next one.
All right, thanks guys.